Look at the top. Consumer staples, utilities, healthcare, and industrials. Wow. You don't hear much about them, do you? You don't hear much about utilities. This utility did that. This utility did the other thing. You hear about the high-tech telephones. You hear about the latest biotech thing. You hear about the latest consumer technology. You hear about the latest fashion. You hear about what's going on in real estate or what's happening to banks. You don't hear much about food. You don't hear much about utilities. You don't hear much about industrials. Less hype, dividends, more potential profit, less trading, more for you. The results at the top of the page are more indicative of the type of stock that favors a long-term investor than a short-term trader. Let's take a look at this for a second. Hi, I'm Chip Stites, and welcome to another edition of the Laughing Retirement video series on YouTube. You know, one of the questions we've gotten all year long is what do I do about a bear market? How do I handle this bear market? I've lost so much money in this bear market. I'm worried about my retirement in the bear market. Well, we have an answer for you. I'm going to take you through this step by step. What I want you to do is think about what I'm saying and think about what it means to you. If you're interested, great. If you're not, you've learned something. In any case, let's screen share here for a second. Let's take a look at this. Why are bear markets a problem? Well, I'll tell you why bear markets are a problem. Bear markets are a serious problem for any investor. I don't care whether you're taking money out of your portfolio or putting money into your portfolio or saving for the first time. It doesn't make any difference. Losing money is a problem. That's why Warren Buffett's rule number one is don't lose money. Of course, we're all going to lose money from time to time. But if you're set up your portfolio not to lose, like mine is, even in the worst of cases, you'll do better. Let's take a look at this. For a saver, a 30% drop like we had earlier this year eliminates 6 years of savings. You want to eliminate 6 years of hard work because the market went down? Everybody says, oh, it doesn't go down very often, but we know it's going to go down. We know this is going to happen. Not only that, but if you look at it historically, and I hate the word averages, and we'll talk about that in another video. If you look at it historically, you're going to have 3 to 4 of these a year. 3 to 4 of these every decade. That means every decade, at some point or another, you're going to have a problem. Why not eliminate that? Because you don't know that the years subsequent to the problem are going to solve the problem. We don't know what's going to happen. And don't give me the word averages, because an average may or may not happen. And an average is something that's created over 50 years. And if you're living today, you don't have 50 years. Your portfolio is today. Your portfolio is immediate. You don't have 50 years to find an average. So for the average saver, a 30% drop represents 6 years worth of losses. If you're saving 10%, it represents 3 years worth of losses. That's 3 years of hard work gone. For the average retiree who is taking money out, this is a double problem. Why is that? Well, say the market drops 20%, you're withdrawing 5. You need that money to live on. Let's say that you have $350,000, the market drops 20%. Now you've got $280,000. But the problem is you still have to withdraw the 5% of the $350,000 you need to live on. That's $17,500. So now your $350,000 is worth $262,500 in 1 year. I don't know about you, but for me, that would be a problem. And I could have withdrawn 5% from my portfolio this year and had no effect on it whatsoever. Wouldn't have dropped a nickel. And I'm going to show that to you in just a second. I'm going to show you why that is right now. Let's take a look at this. This came out of the Schwab website on December 1st, 2022. Notice at the top, 4 of the 11 sectors of the S&P 500 are positive. That means almost half of the S&P 500 is positive. When we're told over and over, everything's down, everything's down, everything's down. Get out of this, get into that. Every time you trade, it creates risk and it favors the person, not the person who's doing the trading, but the person or the financial institution that did it for you. They make money every time you trade. Every time you change something. Look at the top. Consumer staples, utilities, healthcare, and industrials. Wow. You don't hear much about them, do you? You don't hear much about utilities. This utility did that. This utility did the other thing. You hear about the high-tech telephones. You hear about the latest biotech thing. You hear about the latest consumer technology. You hear about the latest fashion. You hear about what's going on in real estate or what's happening to banks. You don't hear much about food. You don't hear much about utilities. You don't hear much about industrials. Less hype, dividends, more potential profit, less trading, more for you. The results at the top of the page are more indicative of the type of stock that favors a long-term investor than a short-term trader. Let's take a look at this for a second. Consumer staples, food, grocery stores, food producers, Kellogg, Nabisco. These things have a tendency to be more consistent to pay dividends. Utilities. Your utilities have a tendency to pay dividends. They don't grow much, they don't change much, they don't go down much, they don't go up much. That's good for a saver. Consistency is better than inconsistency, especially when you're growing your portfolio, and doubly so when you're taking money out. Healthcare. Healthcare has so much in it now, it's a little bit tougher to call, but it does pay dividends. One of my favorite stocks is AbbVie, and it's paid a consistent dividend, and it's up this year. Industrials. Things like metals and mining. Those things. The producers of the things we need to create steel, to make our roads, to grow our economy. You don't hear a whole lot about them, but they tend to pay you. So again, the results are indicative of stock that favors the long-term investor versus the short-term trader. And those things, after all you've heard all year long about how everything is bad, are not bad. They're good. Let's take a look at one other thing. This is my portfolio. This is what it has done this year. The students in class learning how to create the perpetual income engine in the Future Proof Your Retirement series get this every week. This is the year-to-date index. The S&P is down almost 15%. The Russell's down around 15%. The Nasdaq's down around 26%. The Dow's down 5%. And the perpetual income engine is up 5%. So if you're withdrawing from a growth portfolio, you're withdrawing, what, your 5% plus the S&P's loss? You've withdrawn 20% this year, withdrawn or lost. If you're withdrawing from the pie portfolio and you're withdrawing 5%, you haven't withdrawn anything. Your portfolio is worth almost exactly what it was at the beginning of the year, in the middle of all this hype. Let's take a look at a week. Weeks don't make much difference, but my students get to look at them. This is a good week. We have bad weeks, just like anybody else does. The NASDAQ's up 2, the Russell's up 1.3, the S&P's up 1.12, the Dow's up 0.24, and my pie portfolio is up 2.15. Why is that? One of the larger reasons is not only did it go up, but it got dividends into it that were reinvested, just like you would have if you were doing this. That's how you solve the bear market problem. You solve the bear market by being safer. You solve the bear market by being less risky. You solve the bear market by getting dividends. And you solve the bear market by not trading all the time and not buying things that cause you to trade all the time. You see, even if you have a mutual fund that's trading 20, 30, 40, 50% a year, you're trading. If you have an ETF that's trading 5, 10, 15% a year, you're trading. Your money is doing that. Think about what we've talked about. If you like what you've heard, subscribe to this video series and we'll tell you when the next one comes out. And we'll have an annual review towards the end of the year. If you like this, become a member of the laughingretirementcommunity.com on Facebook. You'll talk to some interesting people. You'll get some interesting insights. We'll put up posts twice a week to tell you about what's going on, talk about retirement, not just about the financial part of retirement, but the most important part of retirement, which is doing what you love to do, whatever it happens to be. Making time your own. I hope you'll join us. I'm Chip Stites, your host and creator. Thank you.